Monetary policy. What is expansionary and contractionary monetary policy? How is a country's economic growth achieved? How does a country generate employment? How does the central bank control inflation? What are monetary policy trade-offs and policy mixes? What is monetary policy credibility? What is monetary policy Taylor's rule? What are the limitations of monetary policy? Liquidity trap and black money. Let's understand. What are expansionary and contractionary monetary policy? In expansionary monetary policy, the central bank increases the money supply and lowers the interest rate. In contractionary monetary policy, the central bank decreases the money supply and raises the interest rate. In expansionary monetary policy, the RBI increases the money supply and lowers interest rates. The central bank buys bonds, prints money and gives it to banks. Money supply increases with commercial banks. Central bank also lowers interest rates. You withdraw your money from the bank because you are getting a lower interest rate. Money supply in the economy increases. Or the RBI reduces the CRR, banks will have to deposit less money in RBI reserves, leaving them with more money to lend. Then the central bank also reduces interest rates. You withdraw money from the bank because you are getting a lower interest rate. Money supply in the economy then increases. In contractionary monetary policy, the RBI raises interest rates and reduces the money supply. Central bank sells bonds, for which the central bank borrows money from commercial banks. Money supply of commercial banks decreases. Central bank then increases the interest rate. You deposit more in bank to earn interest rates. Money supply in the economy decreases. RBI can also increase the CRR to conduct contractionary monetary policy. By increasing the CRR, banks will have to deposit more in RBI reserves. Banks will have less money to lend. Central bank will also increase interest rates, which will cause you to deposit more money in the bank to earn interest. Money supply in the economy will then decrease. How is country's economic growth achieved? By implementing expansionary monetary policy, the central bank increases the money supply and lowers interest rates. You withdraw your money from bank because you get a lower interest rate. You buy more goods, and demand increases. Businessmen borrow more money from the bank because interest rates are lower. By taking loans, businessmen increase production. As production increases in the economy, the country's GDP also increases. This leads to economic growth. How does the country generate employment? By implementing expansionary monetary policy, the central bank increases the money supply and lowers interest rates. You withdraw your money from the bank because the interest rate is lower. You buy more goods, and demand increases. Businessmen borrow more money from the bank because the interest rate is lower. By taking loans, businessmen increase production. Production in economy increases, and factories hire more workers, which creates employment and jobs. How does the central bank control inflation? By implementing contractionary monetary policy, the central bank increases the interest rate and decreases the money supply. You deposit more in the bank to earn interest. You save money and buy less. Demand for goods decreases. Previously, demand exceeded supply, leading to inflation. But now, demand and supply are equal, causing demand to decrease. So, inflation decreases. What is monetary policy trade-off and policy mix? RBI's objective is to achieve economic welfare, currency stability, and full employment simultaneously. But the RBI cannot achieve all three objectives simultaneously using monetary policy. If RBI implements expansionary monetary policy for economic growth, it grows by increasing the money supply. Inflation also increases in economy because economic growth will be driven by an increase in the money supply. As money supply increases, you will demand more. And if demand exceeds supply, inflation will increase. This is called growth-inflation trade-off, meaning that if there is economic growth, inflation will also increase. If RBI implements contractionary monetary policy, it reduces inflation. Inflation decreases somewhat due to decrease in the money supply, but an economic slowdown occurs, which increases unemployment. This is called inflation-unemployment trade-off. If the RBI conducts contractionary and expansionary monetary policy, then financial instability occurs in economy because sometimes the money supply increases and sometimes it decreases. So the central bank can either conduct monetary policy or achieve financial stability. This is called the monetary policy financial stability trade-off. What is policy mix? If the central bank has to simultaneously achieve economic growth, inflation control, and employment increase, without any trade-off, then the central bank will have to use two policies, fiscal and monetary policy simultaneously. This is called policy mix. What is monetary policy credibility? Central bank implemented monetary policy, but people feel that monetary policy is not trustworthy and will not bring any change in inflation. People will expect inflation even after monetary policy is implemented. People will make economic decisions based on this, and those decisions can impact monetary policy. So, central banks must consider inflation expectations before conducting monetary policy to avoid adversely affecting monetary policy outcomes. Monetary policy Taylor rule. Taylor rule is a monetary policy framework that guides the central bank on how much interest rates should be adjusted. Taylor rule states that interest rates should be increased if inflation occurs, because if interest rates are raised, people will deposit their cash in banks to earn higher interest rates. This will reduce the money supply in the economy. Inflation occurs when demand exceeds supply. Demand is high when people have more money. Therefore, if people have less money, demand will decrease. Demand will equal supply. Raising interest rates will reduce inflation. Taylor rule considers the difference between actual and potential economic output. Potential output is predicted. The difference between the two is called output gap. If GDP is low, then interest rate should be reduced. If interest rate is low, then people will start withdrawing their deposited money from the bank, because they are getting lower interest rate. Money will come into the economy and money supply will increase. People will buy more goods, and with more money demand will increase. If demand increases, then production will increase. And if production increases, then GDP will increase. Taylor rule considers the price level in the economy and changes in real income. What are the limitations of monetary policy? Liquidity trap and black money. People hoard money instead of investing it. Despite the monetary policy lowering interest rates, demand decreases, and production also decreases. People lose their jobs, leading to increased unemployment. Central bank pursued expansionary monetary policy to stimulate economic growth and employment. But because people hoarded money, economic growth and employment remained unchanged, rendering monetary policy unsuccessful. If same people hoarded black money, which is money earned through illegal means, which is not reported, to avoid taxes, this creates demand in the economy but is not reported in the data, leading to lower GDP reporting than real GDP. Informal sector receiving unfair benefits. So, monetary policy is conducted based on inaccurate data, which has a negative impact on economic growth, inflation, and unemployment, which can also lead to an economic slowdown. That's all about monetary policy. Don't forget to subscribe the channel and press like button for more such detailed videos.